This is a bookable summary of the book, One Up on Wall Street, by Peter Lynch and John Rothschild. Want to invest in the stock market, but don't feel like a pro? Good news, you don't have to be. You can find lucrative investment opportunities close to home with some attention and research. Let me show you how. How to beat professional investors in the stock market. Think you need to be a Wall Street pro to make it big in the stock market? Think again. Being an amateur investor works in your favor. Wall Street analysts have restrictions that prevent them from noticing potential big winners, and they often miss out on the unknowns. Plus, you don't have the same restrictions as investment professionals. But before you start investing, there are 3 things you need to consider. First, make sure you own a house and understand the research that goes into investing in real estate, as it's not that different from investing in stocks. Next, make sure you have the money you can afford to lose, and avoid investing any cash that you'll need shortly. Finally, evaluate whether you have the qualities of a good investor, including patience, decisiveness, flexibility, and the ability to do your research and admit when you're wrong. By considering these factors and avoiding gut instincts and rash decisions, you can beat the pros and make a fortune in the stock market. Look around you for investment opportunities. Investing doesn't have to be a guessing game or a matter of luck. Great investment opportunities are all around you. Whether you're at home, at work, or out shopping, you just need to pay attention to your environment and look closely. As someone who is a professional in a specific industry or consumer, you have the advantage of noticing rising demands for products and businesses entering the market and becoming popular. If you keep an eye out for promising companies, you can invest in their stocks early and benefit from their growth. However, before investing, it's important to make sure that the success you're predicting will have an impact on the company's profits. A wildly successful product owned by a massive company may not contribute much to the firm's overall balance sheet, but a small company can profit incredibly from a popular item. Once you've identified a promising company, you should determine what to expect and when to expect it. You can categorize stocks into 6 categories based on their growth rate: slow growers, stalwarts, fast growers, cyclical, turnarounds, and asset plays. Among these, the fast growers are where you'll find the most 10-baggers, or firms that can up their value tenfold. So, keep your eyes open and don't miss out on great investment opportunities that are waiting for you. The key factors to consider before investing in a stock are: so, you've found a potential investment opportunity, but before you go ahead and invest your money, you need to assess the stock's potential. There are a few factors you need to consider before making your decision. Firstly, the name of the company is important. It might sound trivial, but it can be a valuable clue. Companies with boring names or unattractive industries can easily be overlooked by analysts, which means you can buy their stocks before they become popular and increase in value. Secondly, you need to look at the state of the industry. Companies with few competitors or exclusive products can dominate the market and maximize profits. For instance, a company that produces patented drugs can become the market leader. If you're finding this video to be enjoyable, show your support by liking it and subscribing to my channel for even more fantastic content. Your encouragement means everything to me and drives me to keep creating videos for you. Thirdly, it's essential to examine the company itself. Spin-off companies have a higher chance of success as their parent companies only spin them off if they have potential. Also, if the company's employees or the company itself are buying shares, that's a good sign that insiders have confidence in the company's future performance. Lastly, it's important to remember that you should only invest in a stock after you've confirmed the company will make good profits. Don't rush into investing just because you found a potential 10-bagger. Take the time to do your research and assess the stock's potential for growth. The importance of monitoring a company's earnings. Investing in a company is all about betting on its potential to make money. And that's why monitoring a company's earnings is essential, both before and after you invest. To invest wisely in stocks, you need to keep an eye on a company's earnings and its price-to-earnings ratio. The latter tells you how long it will take to earn back your investment. A good ratio is equal to or lower than the company's growth rate. You should also consider a company's future earnings potential by looking into its plans for growth, expansion, or cost-cutting. By keeping these factors in mind, you can make informed investment decisions that can pay off in the long run. Knowing which stocks to avoid in the stock market. Don't fall for the hype of trendy stock or industry. Even seemingly attractive investments can go wrong. Learn which stocks and industries to avoid to make informed investment decisions. One of the golden rules of investing is to not believe the hype. Companies that gain value based solely on their popularity or trendiness are often overvalued and can come crashing down when real profits fail to materialize or competitors enter the market. So investing in something just because it's hot right now is a risky move. Similarly, stocks that are touted as the next big thing or the next Apple rarely live up to the lofty expectations people have of them. These so-called whisper stocks often lack substance and can be a big disappointment for investors. Another type of investment to avoid is in companies that are making risky acquisitions in an attempt to diversify. These purchases often end up being unprofitable or overly expensive, leading to what the author calls diversification. Finally, be cautious of investing in companies that rely heavily on just a few customers for their revenue. If one customer leaves, the company's earnings could take a massive hit, making it a bad investment choice. Get the inside scoop on companies. Tips for effective research. Investing can be daunting, especially when researching a company. But with the right approach and resources, it doesn't have to be. Your broker can provide you with essential publications, reports, and surveys, as well as help you monitor key financial metrics like insider buying and price-to-earnings ratios. Focus on the consolidated balance sheet for the signs of financial stability and the 10-year financial summary to understand a company's recent performance when reviewing their annual report. If you still have questions, go directly to the source, the company itself. Investor relations personnel are usually happy to speak with potential and current stockholders. Prepare a list of questions based on your research to get the most out of your conversation. Attending annual meetings and visiting the company's headquarters can also provide valuable insights and connections. Remember to reevaluate your investment every few months to ensure it remains a sound choice. By following these tips, you can make informed decisions and feel confident in your investment choices. How to design a good portfolio and manage your stocks for better returns. Want to make huge returns on your stock market investments? Unfortunately, that's not very likely to happen. On average, you can expect annual returns of 12 to 15%. However, you can increase your chances of hitting a 10-bagger by creating a diversified portfolio and spreading your money across different categories. It's also important to know when to buy or sell stocks. Look for bargain prices in October to December or during market crashes, but don't sell a stock just because the price has dropped. Only sell if the company is performing poorly and there's no indication of improvement. To design a good portfolio, consider the 6 types of companies discussed earlier: fast growers, stalwarts, cyclical, turnarounds, asset plays, and cash cows. The author suggests investing 30 to 40% of your money into fast growers and 10 to 20% in each stalwarts and cyclical. The remaining money can go into turnarounds. Remember to do your research before investing and manage your portfolio regularly. This way, you'll increase your chances of getting better returns on your stock market investments. The risk of options and shorts outweigh the rewards. If you've been considering investing in options or shorts, it's important to know that the risks involved far outweigh the potential rewards. These are not the best alternatives to traditional stocks, despite what some people might say. Let's start with options. When you buy an option, you're essentially placing a bet that the stock's value will increase before your deadline comes. But the deadline can come before you see the desired change in stock price, and you'll have to keep buying new contracts to retain your right to buy the stock. This can become expensive quickly, and the odds of success are low. Shorting is another instrument available to investors, but it's also risky. When you short a stock, you're borrowing stocks from an investor, selling them, and then buying them back at a cheaper price to return them to the original owner. But if the stock price increases instead of decreases, you'll be responsible for paying any dividends or benefits, and you could end up in debt. Overall, the risks of options and shorts are simply too great for potential rewards. If you want to invest in stocks, it's better to focus on building a diverse portfolio and making informed decisions about buying and selling. We hope this video provided valuable insights and information for you. Do you believe in the hype of trendy stocks, or do you make informed investment decisions by avoiding overvalued stocks and industries? Let us know in the comments. And if you learned something new in this video, make sure to hit the button and subscribe for more videos. Thank you, and until next time.